Trading is a game of probabilities, and one of the most critical skills that separates consistently successful traders from those who struggle is position sizing. At first glance, it may seem like a dry, technical detail, the mere act of deciding how many units of an asset to buy or sell, but in reality, it's the fulcrum upon which your trading career balances. Position sizing is about controlling your risk with precision, about knowing exactly how much capital to commit to each trade in a way that protects your account and allows you to survive the inevitable losing streaks. Think of position sizing like navigating a ship. You wouldn't load it so heavily that a single wave could capsize it. You also wouldn't underload it and miss the chance to reach your destination efficiently. The size of your position has to be calibrated to the conditions around you, the strength of the currents, the potential storms ahead. In trading, those currents are market volatility, liquidity, and your own risk tolerance. Early in my trading journey, I remember taking positions that were far too large relative to my account. There was a time I had a $10,000 trading account, and I opened a single forex position that represented a risk I hadn't fully calculated. It was exciting, seeing the numbers on the screen climb or drop, but every tick became a source of anxiety. The market moved against me, as markets are always prone to do, and I realized, almost painfully, that the size of my position could have ended my trading career before it had truly begun. That experience was brutal, but it drilled into me a lesson that would define my approach for the next decade. Your position size is the single most effective way to manage your risk. Far more important than indicators, charts, or complex strategies. The first thing to understand about position sizing is the relationship between the size of your trade and your risk tolerance. Risk tolerance isn't just a number you pull out of thin air, it's a deeply personal calculation that considers your total capital, the maximum loss you're willing to endure on any single trade, and your emotional capacity to handle stress. For instance, if you have a $50,000 account and you're comfortable risking 1% of your capital on a trade, that means your maximum risk is $500. Your position size must be calculated so that, if your stop loss is triggered, you only lose that $500, not $1,000. Not $2,000. What's fascinating is how this simple discipline transforms trading psychology. When you know that each trade is a defined fraction of your account, you stop trading reactively. You stop chasing the market out of fear or greed. You can make rational decisions, stick to your strategy, and ride the market's ups and downs without the crushing weight of uncertainty on your shoulders. You begin to understand that trading is not about hitting home runs every day. It's about surviving, consistently, long enough to let your strategies work over time. Another dimension of position sizing is its relationship with volatility. Not all trades are equal, and not all markets behave the same way. A volatile currency pair can swing 100 pips in a day, while a less active pair might move just 20. If you treat them equally in terms of position size, you're inviting disaster. Position sizing must adapt to the volatility of the asset. In more volatile markets, you reduce your position size to keep risk constant. In quieter markets, you can increase your size slightly, without exceeding your risk tolerance. This dynamic approach is what separates amateur traders, who risk blindly, from professionals who manage their risk proactively. Let's revisit a personal experience to illustrate this. I was trading a highly volatile currency pair during a geopolitical crisis. The charts were screaming with opportunity, and the temptation to go big was enormous. But I remembered the lessons from my early mistakes. I adjusted my position size according to the volatility, kept my risk per trade consistent, and despite massive price swings, I survived intact. I didn't make as much as the adrenaline-seeking traders who went all in, but I didn't blow my account either. That consistency over months and years compounds in a way that reckless profits never do. Position sizing is also closely tied to your overall portfolio. It's not just about one trade, it's about how multiple trades interact with each other. Correlations matter. If you take large positions in assets that tend to move together, your effective risk skyrockets even if each trade individually seems safe. Professionals calculate their total exposure across all trades, adjust position sizes accordingly, and ensure that no single event can wipe them out. This holistic view is a cornerstone of systematic trading. Over time, mastering position sizing becomes almost intuitive. You begin to sense the right size for a trade before you even open it. You instinctively adjust for volatility, correlations, and the unique risk characteristics of each market. You become a trader who can act decisively because every decision is backed by rational calculation rather than emotion. You start treating your capital with the respect it deserves. After all, capital is what allows you to keep trading. Without it, strategies, signals, and indicators mean nothing. So, if there's one principle to take away from position sizing, it's this: no single trade should ever have the power to destroy you. Every trade is an opportunity. Yes, but also a test of your discipline, your planning, and your patience. By sizing your positions correctly, you turn trading from a risky gamble into a controlled game of probabilities. You preserve your ability to trade another day, to compound gains over time, and to develop a strategy that can withstand the storms that markets inevitably throw at you. Position sizing, at its core, is a marriage of math, psychology, and experience. It requires you to know your limits, respect volatility, understand correlations, and accept that losses are a natural part of trading. But when implemented properly, it allows you to navigate the market with confidence, discipline, and a long-term perspective that turns risk into opportunity and transforms potential chaos into a structured, sustainable approach to wealth building.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!